Hello, this is Mark from tradinform.com and welcome to this video on which is the best candlestick pattern to trade. This is the first video in a three-part series that will help to transform your candlestick trading. And in this video I will show three different patterns. I will show you what these patterns are and what they look like. I will show you how I have tested these patterns, and I will give you the results that I have got from testing these patterns on real and recent historical data. So the three patterns that I'm going to use in this video are firstly the engulfing pattern. Now this can be either bullish or bearish, and it is where a larger second candle completely engulfs a smaller first candle. The harami pattern is almost the opposite of the engulfing pattern, and this is where a smaller second candle is contained within the body of a larger first candle. And the third type of pattern is the hammer and shooting star. Now these are mirror images of one another. The hammer pattern is a bullish sign, and it occurs when we have a small body with a large wick below. The shooting star is a bearish sign, and it occurs when we have again a small body and a large wick or shadow above. Now I have tested these patterns using the spreadsheet that is shown on the screen at the moment. Now this is a trade-informed backtest model, and it is built completely in Excel, and it is a way of testing all sorts of different trading strategies. And if you would like more information about this spreadsheet or other trade-informed backtest models, there is a link on the screen at the moment and more information below this video. Now, back to this model, if I click on the backtest tab, you can see that what I have done is I have programmed each of the patterns into this backtest model. And you can see we have the green patterns here representing a bullish signal and the red patterns representing a bearish signal. So we have haramis, hammers and engulfing patterns here. Now I've tested this using, as I said, real historical data. I have used the Euro US dollar Forex pair, and I have used the 4-hour time frame. Now the settings that I've used, my initial settings are to take profits. I have used a profit target of 3 times the ATR and a stop loss also of 3 times the ATR. If we look down here, we can see that all 3 of the patterns are currently being tested throughout this backtest period. And if we look over here at the results, you can see we've got a pretty reasonable 14% compound annual growth rate. We've gone from $100,000 to $163,000 over this approximately 4-year time period. Now these results are all well and good, but we need to dive in a little bit deeper and understand which of these patterns is delivering these results and which of them are not helping us. So I can switch them on and off from over here. And looking at them individually, we can see that with these settings, the engulfing pattern is a negative proposition over this time period. If I look at the harami, we can see that this is profitable over the time period, not a huge profit, but it is profitable. Annual growth rate of 3.5% of our capital. And finally, the hammer and shooting star, we can see that this is profitable. It has got a good profit factor, we have a good compound annual growth rate, and a pretty reasonable and fairly low maximum drawdown. If I scroll down here, we can see that both long trades and short trades are delivering the results that we want, which is of course to have profitable trades. We've got a good percentage of winning trades, 70%, so we can see that under these conditions, using a stop loss of 3, an equal stop loss and profit target, that hammer and shooting stars are delivering the best results. Now, we always want to test to see if anything we can do is going to improve our strategy, so we can try a shorter target and stop loss. And in fact, it does increase our winning trade slightly. It doesn't make a huge amount of difference. Some people might well prefer to use that. Likewise, if we used a target of 4 and a stop loss at 4, again, it does not make a huge difference. We do not want a trading strategy that is refined to the tiniest detail in using historical data, because it will not produce the same results in the future. What we want is a strategy that is broadly stable across as wide a range of results as possible. The only factor I would consider with this as being an issue with this strategy is we have a relatively small number of trades. If we were to reduce this again, we'll see that our number of trades does increase, just over 30, but it's still not very many. We're having a trade every few months. However, each of these trades does have a good percentage chance of winning. Now, in the next video in this sequence, I'll be looking at how we can make this into more of a complete trading strategy, how we can get more trades, how we can get more robust results, and how we can get more profit. I'm going to do this using filters. Now, if you enjoyed this video, please hit the subscribe button for more content like this. If you would like more information about trading the financial market, and in particular about how to analyse trading strategies, please go to www.tradeinformed.com.